Welcome. We're digging into China's August 2025 trade data today. Now, on the surface, the numbers point to a story of resilience. But once you look past the headlines, you see a picture of significant structural change. So in this analysis, we're going to decode those headline figures to really map out the fundamental shifts happening in China's trade engine and what they mean for its economy. So let's start with the conclusion right up front. The core thesis here is that the data is really a two-sided coin. On one side, you've got headline growth and a record surplus. But flip it over, and you find a much more complex story. We're seeing a dramatic geographic rebalancing away from the U.S., a real upgrade in the export engine itself. And all of this is happening while the domestic economy is taking on what we call a barbell shape. Strong on the production side, but very weak on the consumption side.
All right, so let's dive into that first major shift, the redrawing of China's trade map. The data shows a deep and, frankly, accelerating pivot in its global partnerships.
And nothing illustrates this better than this chart. It's truly a tale of two markets. You see exports to the United States plummeting by over 33% year-on-year. At the same time, exports to the ASEAN bloc surged by 22.5%. And let's be clear, this isn't just a blip on the radar. This divergence is the central narrative of China's new trade orientation. Now, if we zoom out a bit, this table really shows the diversification strategy in action. Look at the U.S. market. It created a 5.1 percentage point drag on overall export growth. But that was more than canceled out by gains elsewhere. ASEAN, a recovering European Union, whose manufacturing PMI just returned to expansion for the first time in 3 years, and very strong growth with Africa all show how this multipolar approach is working. However, that surge in exports to places like ASEAN deserves a closer look. A big part of this growth is what's called re-export trade. That's where goods are shipped to countries like Vietnam before heading to their final destination, often as a way to get around tariffs. Now, this has been a pretty effective strategy, but it's starting to attract scrutiny. We're seeing countries like Mexico, for example, imposing new tariffs specifically to curb this practice. This means these new trade routes are themselves becoming new points of geopolitical risk. Okay, so that covers the where. Now let's talk about the what. This brings us to our second key theme, the evolution of the export engine itself. The data makes it very clear that the type of goods China is selling to the world is fundamentally changing, marking a real move up the value chain. And this slide really gets to the heart of it. We're seeing a clear engine switch. Exports of traditional labor-intensive goods actually shrank by 6.6%. Meanwhile, exports of high-tech products grew by almost 9%. This is a classic structural handover from the old drivers of growth to the new ones. So what's powering this new engine? Well, it's really three key high-tech sectors. First up, integrated circuits. Exports soared by nearly 33%. This reflects both a cyclical recovery in the global semiconductor market and, of course, China's own expanding capabilities in this space. Second, we have shipbuilding. The export value here jumped almost 35%. This is being driven by global demand for new, more efficient vessels, an area where Chinese shipyards have really carved out a leading competitive position. And finally, the automotive sector. Export value grew over 17%. And this is almost entirely powered by new energy vehicles, or NEVs, which are aggressively capturing global market share. But there's an important detail hidden in those strong auto numbers. While the value of auto exports grew 17.2%, the volume, the sheer number of cars, grew by 24.3%. This gap tells us something important. It suggests intense price competition, a strategy you could call trading price for volume. While that might help clear out domestic inventory, it definitely raises questions about how sustainable the profit margins are for these exporters. Okay, we've talked a lot about what's leaving China. Now let's flip the script and look at what's coming in. Import data is a crucial barometer for the health of the domestic economy, and the picture it paints is one of profound imbalance. The best way to understand this imbalance is to think of it as a barbell economy. On one end, you have a strong, policy-driven production sector. On the other, very distant end, you have a weak, market-driven consumption sector, which really reflects lagging consumer confidence. And we see clear evidence for the strong production end of that barbell. Import volumes for key industrial commodities like iron ore and copper ore are still growing. That tells you manufacturing and construction are still active. Similarly, the rise in integrated circuit imports points to continued activity in high-tech production and assembly. But then you look at the other end of the barbell, the consumption side, and the picture couldn't be more different. This number is probably the single most powerful piece of evidence, a 50.5% collapse in the value of imported automobiles. A high-ticket item like that sends an unmistakable signal. Domestic demand, especially for high-value foreign goods, is exceptionally weak.
So that's the picture as of August. But what about the path forward? Well, while the data shows resilience, the outlook is clouded by some significant challenges and uncertainties that are really going to test that resilience.
Two critical factors are looming. First, there's a high base effect. Back in late 2024, companies rushed exports to get ahead of tariffs, creating a spike. That's going to make the year-on-year growth numbers look tough in the fourth quarter. And more importantly, on November 10th, the US-China tariff truce is set to expire. That introduces major uncertainty and the potential for a significant re-escalation of trade friction. And all of this brings us back to the central question. On one hand, China's trade performance shows a clear strategic success. It's diversifying markets and upgrading its export structure. But this is happening against a backdrop of rising geopolitical friction and a domestic economy that's really struggling with weak internal demand. So, we're left to consider, facing these external shifts and internal imbalances, just how solid is the foundation of China's trade resilience?